My feeling is, we really have been advancing over the last 4 or 5 months, really without any kind of a break whatsoever. So I think, we need to take a bit of a breather. Right now, 71% of the sub-industries in the 1500 are above their 50-day moving average. So I just think that it's time for us to reset the dials a little bit before we experience what I call the PEP, post-election pop.
How about that blowout manufacturing number that we just got? People reading into that, what does it tell us about where we are in this cycle and the sustainability of 4% plus economic growth? Well,
I think you're asking the right question in terms of the one word, sustainability. How does it get much better than this? So when you look to the 22% earnings growth expected this year, 10% earnings growth next year, that's been around for a couple of months. What's going to move that higher? Right now, we're looking at valuations that are still the second highest of bull markets since World War II. Again, what's going to allow that to work its way higher? Right now, it's lack of competition. And while I do think that we could end up seeing about a 6 to 6.5% price appreciation over a coming 12-month period, I think we have to sort of readjust the trajectory of expectations.
Barry, what do you make of Sam's numbers?
Yeah, to me, the ISM, I wouldn't read too much into it. In front of the trade conflict, there's been some channel stuffing, for lack of a better word, just front-loading a production schedule, so some of that is going on. I think the thing you've got to worry about is the Fed. If they're going to do their job, they have to raise us to a positive real rate, which will lead to multiple compression to offset some of those rosy earnings numbers. This leads to a topping out of the stock market, and I guess you'd call it a transfer from Wall Street to Main Street in terms of prosperity, which is probably in line with some of the politics today.
So are you referring to 19 or December? Are you getting that granular here?
Well, this year, obviously, you don't have much more than the 2% interest rate, and you're at zero real rates. Next year is the question mark. Will the Fed conform to its dot plot and go to about a 3% rate while most of the developed world central banks are still at a negative short rate? If that happens with growth differentials and rate differentials, wouldn't be surprised to see a stronger dollar, some trimming of earnings estimates, and a lower PE multiple for the S&P, even though earnings are up.
Sam, no surprise that higher rates might be a concern for some. Do you agree?
Yes, but I think that's something that is in 2019. We have not had a bear market start over the past 60 some odd years whenever the inflation rate has been above interest rates. And we're going to need 2 rate hikes this year just to get to the inflation rate. So I think we have to move well into 2019 before we start to see higher rates become a threat to the stock market growth.